You know that feeling. The market's doing its usual volatile dance, and suddenly just holding cash feels like the only sensible thing to do.
Oh, yeah. That urge to just play it safe, sit on the sidelines.
Yeah.
It's strong when things feel uncertain.
Totally understandable. But today we're going to dig into why that super safe feeling might actually mean you're missing out.
Right. Is it really the best strategy long term?
Exactly. So the mission for this deep dive is to look at why sticking with cash indefinitely maybe isn't the power move, especially, when some really solid dividend-paying companies seem to be trading at bargain prices.
We want to see if there's a way to maybe capitalize on this current moment, find some value without needing, like, a finance degree.
Yeah, precisely. And we're focusing on two specific examples highlighted in an article we looked at. Two companies presented as potentially, compelling opportunities despite all the market jitters.
And those are 3M, ticker MMM, the big industrial name.
You see their stuff everywhere.
Right. And Verizon Communications ticker VZ, the telecom giant.
Now, let's be real. These probably aren't the stocks lighting up social media feeds.
Definitely not the hype stocks.
But that's kind of the point, isn't it? We're going to explore why these maybe less exciting names might actually be smart places to look right now. Okay, let's get into it.
So, starting with that cash temptation. Like we said, emotionally, it makes total sense. Feels secure.
It does.
But thinking about building wealth over time, cash usually doesn't do that job, especially if, good companies look cheap. The article used a great analogy.
Oh, I liked this one.
Yeah, it's like choosing plain rice cakes when there's, like, gourmet steak on sale.
Right. Going for the safe, kind of bland option when something potentially way better value is right there, marked down.
And this isn't about trying to perfectly time the market either, Buy the absolute bottom, sell the absolute top.
Which is basically impossible for most people anyway.
Exactly. So the article frames this through value investing. It's more strategic. It's about spotting when a really strong company, fundamentally sound, is trading for less than it seems like it should be worth.
So you're looking at the business itself, not just the squiggly lines on the stock chart.
Precisely.
Yeah.
Identifying that quality when the market maybe isn't appreciating it.
And a really crucial part of this for today's discussion is locking in those high starting dividend yields.
Yes. This isn't about chasing tiny yields from stocks that are already popular and expensive.
Right. It's finding these potentially overlooked companies that are paying out significant dividends now with the idea that the stock price might recover later, too.
Exactly. Which brings us neatly to the first pick. 3M, ticker MMM.
Okay.
So right now you're looking at a dividend yield around 6.4% and a forward PE, price to earnings, around 11.
That yield definitely catches the eye. But okay, let's address the elephant in the room for 3M.
You have to. The legal issues, the earplugs litigation, the PFAS, forever chemicals. These are serious. We're talking potentially billions in settlements.
Billions. That's a big number. You can't just brush that aside.
No, you absolutely can't. There are real challenges. But the article makes counter-argument. It suggests that maybe, just maybe, the market has already priced in a lot of that bad news.
Like, the current stock price already reflects a pretty negative outcome.
Sort of.
Yeah.
And it points out that 3M has already set aside significant funds for these settlements. They're actively working on getting global resolutions sorted out.
Okay, and then there's the other piece, the spinoff. They're planning to separate their healthcare division.
Yeah, and that's a really big deal, potentially. Healthcare is apparently their most stable, most profitable segment. So spinning that off could unlock value for shareholders. It lets investors look at the remaining industrial business more clearly, especially once some of that legal fog starts to lift.
And even with all these legal things hanging over them, the article stresses that 3M keeps generating strong free cash flow.
Right. That's the cash left over after running the business and investing in it. Crucially, that cash flow comfortably covers the dividend they're paying out.
Which is pretty impressive given the circumstances.
It is. And it leads to this really key point about 3M's history. They're not just any dividend payer, they're a dividend king.
Okay, explain that.
A dividend king is a company that hasn't just paid, but has increased its dividend every single year for, wait for it, over 60 consecutive years.
60 years. Wow.
Yeah. I mean, think about the consistency that requires through recessions, market crashes, everything. It says a lot about the underlying strength of the business.
So why look at 3M now with these clouds still around?
Well, the argument is the valuation. The stock price is apparently the lowest it's been since the early 2010s. It's not just cheap, it's historically cheap for 3M.
That forward PE of 11 does seem low for a company like that.
It does. It suggests a lot of pessimism is baked in, and the potential upside if things resolve reasonably well. The article floats the idea of the stock recovering, maybe from around $90 now back towards, say, $130 over time.
Plus, you're collecting that 6% plus dividend yield while you potentially wait.
Exactly. So maybe it's not a sexy stock,
Definitely not.
but the case is built on reliability, maybe being a bit contrarian, and that underlying financial strength, despite the headlines.
Okay, makes sense. Let's switch gears then. Second pick, Verizon Communications, ticker VZ.
Verizon. Okay, yield here is even slightly higher, around 6.7%, and the forward PE is lower still, about 8.
8. Wow. Okay.
Yeah, and the article calls it a hated but necessary stock, which feels pretty accurate.
Right. You hear a lot of negativity, don't you? Worries about wireless competition being brutal.
Cutthroat. Yeah.
The massive amounts they had to spend on 5G, and yeah, the stock price hasn't exactly set the world on fire.
No, it hasn't. And those are valid concerns. They've definitely weighed on the stock. But again, the argument is the market might be focusing too much on that negativity.
And missing what?
Missing the fact that Verizon is just a free cash flow machine. Again, that reliable cash generation.
So more stable perhaps than some others in the space. The article contrasted it with AT&T's past struggles and T-Mobile's focus maybe more on growth than immediate profit.
Right. Verizon is presented as this consistent revenue generator that's pretty disciplined about managing its debt.
Okay. And what about all that 5G spending? That's done now, mostly.
Largely, yes. The heavy investment phase seems to be mostly in the rearview mirror. So now, as more people actually use 5G, Verizon could benefit from operating leverage.
Meaning profits could grow faster than costs?
Exactly. Margins could potentially expand. Plus, you've got those high barriers to entry in telecom, getting spectrum licenses, building the actual network. It's not easy for new players to just jump in.
And they have a huge, pretty sticky customer base already.
Very sticky. And importantly, even with that high 6.7% yield, the dividend payout ratio, the percentage of earnings paid out as dividends, is apparently reasonable.
Suggesting the dividend is sustainable. They can afford to keep paying it.
That's the idea. It seems well supported by the profits.
So even if the stock price just stays flat, you're getting that nearly 7% return from the dividend.
Which isn't bad in itself. But the article also suggests that if sentiment changes, maybe they show good subscriber growth, prove the 5G investment is paying off, the stock could get re-rated.
Meaning the market might decide it deserves a higher PE multiple.
Yeah, maybe it moves back towards a PE of, say, 11 or 12. That could imply like a 30-40% upside in the stock price itself on top of the dividend.
So Verizon is like the reliable, maybe unloved cash cow in a sector that's just not fashionable right now.
That's a good way to put it. Provides an essential service, throws off a lot of cash, but isn't getting the tech darling spotlight.
Which kind of leads to the broader psychology here, doesn't it? Why are stocks like 3M and Verizon potentially overlooked? The article basically says they're boring.
Pretty much. They're not caught up in the hype cycles around AI or crypto or whatever the next big thing is supposed to be.
It feels like a throwback to a more traditional investing style, focusing on steady income from established companies, making actual tangible stuff, or providing essential services.
Yeah, less about chasing narratives and more about fundamentals and reliable income streams. Choosing these now is kind of a deliberate step away from the market frenzy.
Okay, but we have to be balanced. No investment is risk-free. The article did lay out specific risks for both, right?
Absolutely critical to acknowledge those. For 3M, the risks mentioned were things like, what if the final legal settlements end up costing more than they've budgeted?
Yeah, that's a big what if.
Or what if the broader industrial economy slows down more, hitting their sales? Or maybe executing that healthcare spinoff hits some snags. Those are real possibilities.
And for Verizon?
Risks there included ongoing price wars in wireless, that competition isn't going away. Also, maybe the payoff from their big fiber and 5G investments takes longer than hoped, and they still have a lot of debt they need to manage carefully.
So these aren't slam dunks. There are potential downsides.
Definitely not. But the article frames it as taking, hopefully, intelligent risks, where you look at the potential reward versus those potential downsides. The argument being that maybe the worst-case scenarios are already kind of reflected in today's low stock prices.
Risk is inherent, but maybe it's somewhat priced in here.
That's the value investor's perspective often. And just to put some numbers on the income potential, the article did a simple illustration.
Right, the dividend math.
Yeah. Say you invested $10,000 in each stock. Based on current yields, that's about $1,310 combined in dividends per year. a blended yield of around 6.55%.
Okay.
And if you just reinvested those dividends, even assuming zero price growth for 10 years, just purely for illustration,
Which is probably unlikely, but okay.
right, just to show the compounding, that initial $20 K could grow to maybe $28,000, and your annual dividend income would climb to over $1,800 just from dividends piling up.
And obviously, if the stock prices did go up even modestly over that decade,
And your total return would be significantly better. It just shows the power of that starting yield and reinvestment.
So, wrapping the key takeaways, 3M and Verizon look potentially undervalued because of specific headwinds, legal stuff for 3M, negative sentiment for Verizon.
But both offer really attractive dividend yields right now, backed by businesses that are still generating a lot of cash.
The core idea seems to be try to ignore the market noise, focus on the underlying value, focus on the reliable income.
Yeah. Maybe these aren't stocks for quick flips, but potentially solid anchors for a longer-term portfolio. Dependable pieces.
So, as we finish up this deep dive, it's pretty clear that while market volatility feels unsettling, makes you want to run for cash.
Understandably so.
Those same conditions might actually be throwing up opportunities. Chances to buy into fundamentally decent companies, paying good dividends while they're temporarily out of favor.
We looked closely at 3M, that dividend king facing headwinds, but with recovery potential, and Verizon, the unloved telecom giant, churning out cash and a hefty yield.
So maybe the final thought for you, the listener, is this. Where do these kinds of stocks fit, or could they fit, in your own investment thinking? Are you potentially missing opportunities by focusing only on what's currently hot or hyped?
Yeah, it's worth thinking about that difference between, say, the perceived risk of going against the crowd versus the fundamental risk of maybe overpaying for a popular story.
Food for thought. And as always, remember this was just exploring the ideas in the article. Definitely do your own thorough research before making any investment decisions.